Pondicherry. I welcome all of you students to this live class. I hope all of you are keeping yourselves safe and staying at home. Please make studying a habit. Inculcate this habit in your personality and it will never leave you even when you grow old. Times are difficult, but a strong mind will keep you closer to books. So I wish all of you will be strong in your mind and as you study, you'll keep pumping energy into the hearts and minds of your near and dear ones. So keep studying, students. Don't leave your books even at these difficult times. Shall we now go to our topic? And today's topic is a chapter of financial management. I already went into the details of this chapter on the 3rd of this month. Today, I will be summarizing the topic through a flow chart and taking up related questions also. So here on the screen is the flow chart flashed over here. And so students, what does this chapter teach us? The whole chapter at a glance, what does it teach us? Let us first go to the role of financial management. I already taught you about the balance sheet when we studied in 11th standard. And we studied that the liability side of the balance sheet will show us the long-term and short-term funds. It will show us the breakup of the long-term funds, which can be debt and equity. These two items appear in the liability side of the balance sheet. If you see the asset side, you will see the composition of the fixed assets of the business and also the composition of the current assets of the business. So students, the liability side shows the long-term and short-term funds, whether it is debt or equity, and the asset side shows the current asset and the fixed assets. Where do we show profits? It's a capital. So it's always C plus L is equal to A. Capital plus liability is equal to assets. This is the balance sheet. And to have a very good balance sheet is the role of financial management. Did you understand, students? The role of financial management is a very good balance sheet showing fixed assets and current assets on the asset side of the balance sheet, the long-term and the short-term funds, which can be split into debt and equity, and also the capital in the form of the statement of profit or loss. So a beautiful balance sheet is the role of financial management. A good financial manager will see that he has a well-balanced balance sheet. That is the role of a financial management. So students, what are the objectives of financial management? The objectives are, the primary objective will be to maximize the wealth of the shareholders, which is also called the wealth maximization concept. So wealth maximization is the primary objective of financial management. The other objectives are also profit maximization, to try and keep the funds very safe, utilization of the funds in the most efficient manner. That is, we should not use it for any other purpose. You should use it for the purpose for which you have got that capital. And meeting the financial commitments is the last objective of financial management. We will have many commitments to run a business. We have to have finance for that. That is another objective of financial management. So having studied the role and objectives of financial management, we have to understand that to manage finance, financial decisions has to be taken. These decisions can be three types. They are divided into three important decisions. The first one is the investment decision. The second one is the financing decision. And the third one is the dividend decision. We taught you the chapter of cash flow, the cash flow statement, how it has to be prepared. We studied this chapter in accountancy. You also studied this for your project works and you have written your project work exams. And so students, it's just a summary of cash flow statement. And in the cash flow statement, we have investment activities, the financing activity, and the operating activity. And so what is it, students? They are to look into the asset side of the balance sheet gives us an investment decision. To look into the liability side of the balance sheet will give us the financing decision. To look into the profit or loss of the business will help us to understand and to take the unnecessary dividend decision. So again, we are going back to a balance sheet. Students, all our work over here will be rotating in and around the balance sheet. So in the balance sheet, if we will have to take the first decision, which is called the financing decision. What is the meaning of financing decision, students? The meaning of financing decision, students, is we should understand how we'll finance our business. For this, we have to understand what will be the proportion of our own funds and what will be the proportion of borrowed funds. Owner's funds is also called equity and borrowed funds is called debt. A very good proportion of equity and debt is called a capital structure, and this is also called a financial leverage. And we have to take this decision as to how much will be our equity and debt. Such a decision is called financing decision. The factors that are involved in taking a very good financing decisions are, please see on your screen, students, the factors. The cost that will be involved in having a particular type of capital, the cost of equity or the cost of debt. The cost of debt will involve the cost of paying interest and also to repay the debt, which is the principal amount at the due time. This is the cost involved in debt. There is not much cost in equity, but you have to satisfy them and keep the earning per share to a very good level. I will be teaching you what is earning per share in the coming topic. So cost will be a very important financing decision. Based upon the risk that you can take, we will have a very good financing decision. What are the risks, students? If you are going to issue debt, debt will involve the payment of interest. Debt will also involve the returning of the principal amount at the due time. The risk is, if you do not have enough profit, you will not be able to meet the obligations of interest payment. And so what will happen, students? Far will be the question of paying back the principal amount. Under such circumstances, the rules and regulations say that the company will have to be liquidated, that is, turned into cash, and with that amount, you have to pay the interest or you have to pay back the principal amount. This is the risk involved in debt. What is the risk involved in equity? Not much, students. It is owner's capital. No one is going to ask you their funds back. It is their funds and they are the owners. Not much risk, but the risk will be that you satisfy the shareholders in the long term. This is another factor that you will keep in mind while taking a financing decision. The next factor to be kept in mind is the flotation cost. What is the meaning of flotation cost? You make a paper boat and you put the paper boat on water and just give a small push to it and it will start floating in the water. This is called floating of a boat. Similarly, when we have to start a company, all the necessary documents that are required has to be prepared. You have to take the necessary certificates, use a promoter to promote your business, and this entire process is called flotation, and it will require a big expense. Depending upon how much flotation cost you can spend, you will take a financing decision. This is another factor to be kept in mind. Let us see the fourth factor, students. The fourth factor will be the fixed operating cost, that is how much cost you need to operate your business. The control consideration will also be a big matter. I would like to explain what is the meaning of the control factor. If you are going to issue debt, you will continue to be the manager of the business. No one can claim control over your business. But you have just borrowed funds, you will pay them their due interest, and in the due time, you will give back the principal amount. There is no risk of anyone capturing your control. But if you are going to issue equity, the risk will be that the control will be divided among all those who are shared in the capital of your business. So if you want to risk the control, if you're ready to risk the control, you will go for equity. If you're not ready, you will go for debt. This is another factor to be kept in mind while taking a financing decision. The last factor to be kept in mind is the state of the capital market. The capital market is always changing. You all see the stock market, which is called the capital market. It's very volatile. The meaning of volatile is it changes very quickly. Keeping in mind what is the state of your capital mind, you will take a financing decision. What is the financing decision, students? Decision as to how much equity and how much debt will contribute the capital structure of your business. Having decided this, let us go to the next decision which has to be taken, and that is the investment decision. The investment decision is reflected in the asset side of your balance sheet. The investment decision will say as to what is the structure of your assets, mainly the fixed assets. With your capital, you are going to buy that land, that building, that machinery which is required for your business. So this decision as to what type of fixed assets you are going to buy, which is also called the capital budgeting decision, is called the investment decisions. What are the factors you will keep in mind in order to take a very good investment decision? What is the cash flow of the entire project? Cash flow will be there, that is, cash will flow out if you are going to have any expenses. Cash will flow in when there is income. A cash cannot flow between bank to hand, cash at bank to cash at hand. No, cash cannot flow in this way. Cash can only flow between a non-current item and a current item. This is called cash flow. So you can use cash to buy a machine, to buy a plant, to buy furnitures and fixtures. This is called cash flow. So when you are spending money for purchasing assets, I call it as cash outflow. When you are receiving money, I call it as inflow. This will be some incomes. So depending upon how is the cash flow of your business, you will take a very good investment decision. The next factor to be kept in mind is the rate of returns. The rate of returns will signify the amount that you are getting on your capital. This will be the rate of return. Depending upon how much rate of returns you are getting, you will have an investment decision. The last factor to be kept in mind will be the investment criteria as to where you're going to put these funds. You have to decide the best way to put these funds and see to it that the money is safe, the money is utilized, because you cannot reverse this decision. An investment decision is a long-term decision. You cannot reverse this decision. So you have to take a very good decision as to what will be the investment criteria. So this is what is called the investment decision. So thus we have seen, students, the balance sheet in which we saw the financing decision, which will be reflected in the liability side, and we have seen the investment decision, which will be reflected in the asset side. This does not complete our financial decisions. we have to take a very good dividend decision. What is the meaning of dividend decision? Our shareholders are very, very important. Debt is something which we cannot always use in the long run. Debt is something which has to be returned. It will not be there with you always. So you have to depend upon equity. What is the meaning of equity, students? Issue shares and make the shareholders as the owners of this company. You have to keep them happy. For this, you have to see that you have enough profit to distribute as dividends among them. To take a very good dividend decision, we call it as the dividend decision, students. You have to have enough amount to divide among the shareholders. This is called a dividend decision. Shall we quickly see the factors to be kept in mind in order to take a dividend decision? The amount that we are earning, the stability of earning, which is very important. Your earnings must be stable. What are your growth opportunities, expansion, and wherever there is need of change? Cash flow positions, which I just now taught you. The shareholders' preference is also very, very important, students. It has to be kept in mind. Depending upon the taxation policy, how much tax is to be paid, you will take a dividend decision. I will come to this in my later topic. What is the stock market reaction? Seeing the stock market reaction, whether the reaction is bullish or it is bearish, I will come to that point. So seeing that, you will take a dividend decision. The access to the capital market, that is how easily you can get your equity or your debt. This is another factor to be kept in mind. The legal constraints, this is another factor, students, in which we are going to see the rules and regulations. And the last is the contractual constraints. And what is the meaning of contractual constraints, students? When you are going to go for big loans from financial institutions like the ICICI Bank or the IDBI Bank, these are all large financial institutions. They will not allow you to go in for any other type of capital, because they are more interested in seeing to it that they get back their interest and their principal amount in due time. So they will compel you through a contract not to go in for any other difficult types of contracts. These are called contractual constraints. Keeping in mind these factors, we take a dividend decision. What is a dividend decision, students? You have taken money from the shareholders. You have to satisfy them by paying dividends. For that, you will keep these above factors that I taught you in mind and take a dividend decision. So financial management involves these three decisions: the investment decision, the financing decision, and the last one is the dividend decision. This is what I have already taught you and we have taken, students. Now let us go further as to what this topic tells us. Beyond this, we are having the financial planning. Financial planning will be very, very important. When we studied management, students, we understood that planning is the first step of management. Without a proper plan, we cannot do financial planning. So financial planning is very important. Why? Because it solves the purpose of two important objectives: to ensure availability of funds whenever required. You have to plan in such a way that there will be funds always in your business. The second objective will be that the firm should not raise unnecessary resources. There shouldn't be any idle capital. There shouldn't be capital which is not necessarily lying, because always is a cost on capital, either to pay interest on debts or to pay dividends on equity. So it requires huge costs. So you should not raise unnecessary resources. So these are the two important objectives of financial planning. We have these objectives, and for that, financial planning is for fulfilling these objectives, financial planning is important. What are the importance of financial planning, students? The optimum utilization of the funds. You have to use the funds to the last scrap. Shouldn't waste funds. Coordination among all functional areas is another importance of financial planning. Without that, you will not have a proper plan. Avoiding wastage of resources is another importance of financial planning. Financial planning will also reduce any uncertainties. You will keep many factors in mind, as I have told you in the earlier topic. You'll keep many factors in mind and thus take a financial decision. So this is also another importance of financial planning, that it reduces financial uncertainties. The last one is it links the present with the future. Financial planning will lead you to a better future. It's a planning which takes you to the future. So it links the present with the future. This is what you understand about financial planning. Without a plan, can you go forward, students? Even for a small work, you have to plan. If you are having a small fete in your school, you have to plan what to do. Then how can a businessman escape from planning when he has to do financial planning, when he has to do a business? So it becomes necessary to have a financial plan. Having studied financial planning, what shall we do with a very good financial plan? We will decide about a very good capital structure for our business. Imagine a home, students. The skeleton of the home is rods and cables everywhere. It forms a skeleton of the home. If that is strong, then the building will remain strong, the home will remain strong. In the similar way, a business cannot be strong without a proper structure. I call it as capital structure. A capital structure can be a combination of many types of capital. They can be equity, they can be debt, there can be other forms like retained earnings, and you can go in for bonds and so many other types which I already taught you in 11th standard. The sources of business finance. So with that, you will choose a particular capital structure. What are the factors to be kept in mind in order to choose a capital structure? The cash flow position, just now we saw, students, the inflow of cash and the outflow of cash. The interest coverage ratio, students, with whatever you are having, whatever profit you are having, you should be able to cover the interest that has to be paid with that. So you will calculate the interest coverage ratio for that. You also have to return back the principal amount. I call it as servicing of debt. For this, you will calculate the debt service coverage ratio. We also will have to see the factor of return on investment. I will come to return on investment through trading on equity, but return on investment is very, very important to the shareholders. The cost of debt will also be another important factor to be kept in mind while you are deciding a capital structure. The cost of debt will include the payment of interest and the repayment of the principal amount. The tax rate is another important factor to be kept in mind in order to take a very good in order to have a very good capital structure. The government will fix a tax rate. A tax rate can be very difficult upon a business. Depending upon how much tax rate they are able to tolerate, they will take take a capital structure in mind. If you are going for debt, you don't have to pay much tax. But if you are going for equity, the tax will be much more higher than debt. So keeping in mind how much tax you're ready to pay, you will have a capital structure. The next factor to be kept in mind is the cost of equity. You will have equity also at a cost. If it is equity share capital, it also can be preference share capital. If it's equity share capital, the cost will be much lower than issuing of preference share capital. In preference share capital, you will have to pay dividends, which will become important. So this is another factor to be kept in mind. The next factor will be the flotation cost. Just now we saw, students. Another factor to be kept in mind is the risk consideration. If you are going to issue debt, there will be higher amount of risk. The risk will be the liquidation of the company. That is, the company can be sold off and converted into cash if you are not able to pay the interest or to return the principal amount in time. So keeping in mind how much risk you are ready to take, you will decide a capital structure. The flexibility is another important factor to be kept in mind. What is the meaning of flexibility, students? Where you can shift from one capital to another, we call it as a flexible type of capital structure. Owner's capital, which will be retained earnings, this can be pushed in your capital structure to give you more flexibility. The next factor to be kept in mind is the control. Control will be more when you are going to issue debt, but control will be lost if you are going to issue equity. Depending upon how much control you want, you will decide a capital structure. The regulatory framework will also be a very important factor while deciding a capital structure. What is the meaning of a regulatory framework, students? The SEBI is a regulatory structure. The income tax department will be a regulatory framework. These people also will have rules and regulations for a business. So what are the rules and how is the rules going to help you? Depending upon that, you will take a very good decision regarding your capital structure. The stock market situation is also another important factor to be kept in mind when you are going to go for a capital structure. The stock market is a very volatile market. It changes very quickly. So the confidence that you want will come from a very good structure and it will also be reflected through the stock market dealings. So stock market will be another important factor to be kept in mind. The last factor to be kept in mind will be the capital structure of other companies. The capital structure of other companies, of other similar companies, will also be another important factor to be kept in mind. So an ACC cement and an Ambuja cement, both are dealing with cement, they can have a similar capital structure. So like this, you can connect with companies similar to you in order to decide a very good capital structure. So this is what I want you to understand about capital structure, students. Having understood capital structure, we will now try to understand what are the types of capital. Capitals are of two types. One is the fixed capital and the other is the working capital. What is the meaning of fixed capital, students? When the capital will be as capital for more than a period of 1 year, I call it as fixed capital, students. It also is called capital budgeting decision. How much fixed capital you require? That's called a capital budgeting decision. So fixed capital is the first type of capital and the second type of capital is the working capital. Working capital is a capital which will remain as capital for a period of just 12 months. So when we call it as the current position, and working capital will just be some excess current asset over your current liabilities. Current assets may be cash in hand, cash at bank, some of your debtors, some bills receivable, etc. This is what is called current asset. What are the current liabilities, students? The current liabilities can be bills payable, some of the creditors to whom you have to pay, or they can be certain small term loans which are just for a period of 1 year. If after having fulfilled your current obligations, which is your current liability, if any asset is left out, I call it as the current asset. So current asset position will give you working capital. And as the name suggests, students, working capital is a capital that you require for day-to-day operations. So this is another important capital. So capital are of two types. One is the fixed capital and the other is the working capital. Now, capital is going to be very important for any business organization. What is the importance of capital, students? The first is the long-term growth of the organization. The business should go on. This is an assumption that you don't start a business to stop it at some point. It goes on and on. So long-term growth is a very important for a business organization. It also decides the large amount of funds that are involved. So the large amount of funds that are involved. So capital will show us how much funds we require. It will always be a very large scale for a big business. Capital is also important because it will tell us about the risks that are involved. And please understand that fixed capital decisions are irreversible. So let us go to the importance of fixed capital, students. It will give us long-term growth. It will give us large amount of funds. It will help us to solve our risk problems. But the last importance is it is an irreversible decision which will help the company to go on and on. Quickly, let us see the factors which you'll keep in mind for taking a capital budgeting decision. The nature of your business, the scale of operation, the choice of techniques, the technological upgradation, growth prospects, diversifications, financing alternatives, and the level of collaborations. All these are factors to be kept in mind in order to take a capital budgeting decision. These are quite complex. So a good financial manager understands financial management very well in order to take a capital budgeting decision. What are the factors which affects the working capital decision, students? Nature of the business, which will be whether it is a business dealing with trading or with manufacturing. The scale of operation, whether the operation is big or small. The business cycle, which involves starting from the purchase of raw materials till the sales of the finished goods. It is called the business cycle. There are also seasonal factors to be kept in mind. For example, if it's an agriculture business, seasonal factors will be very important. At particular seasons, the working capital requirement will be more, and at a particular time, the working capital requirement will be less. Depending upon the season, you will take a working capital decision. The production cycle will also say how much working capital you require, that is the cash that is required at hand. The credit allowed, the credit away, you will also be giving credit, you will also be taking credit. This is called credit allowed and credit away. The operating efficiency, which is very important. Availability of raw materials will play an important factor. The growth prospects, the level of competition, and the last is the inflation, where the economy will also play a very important role in deciding the capital of the business. So students, we have understood this chapter. We have come to this chapter as a whole, and we have understood that starting from financial management to financial planning, the types of capital and the factors that are to be kept in mind for different conditions, all that we have seen. But now let us quickly go to some of the questions, the related questions of this chapter, in order to see what sort of questions can come and what will be the type of answers for that question. So students, I will be going on from very short answers, which can be multiple choice questions, one word answers. They can be a small definition. They can be just a small sentence. This will be one word answers. From here we go on for something like 3 marks, which will be short answers. From there we will be going on for 4 marks, 5 marks and 6 marks questions. The 6 mark questions will be the longest questions, and we'll also see some hots before we end up this session. So students, let us see some of the questions which I bring to you through slides, and let us go to the first question. Okay, the cheapest source of finance. What do you understand by that, students? If you see debenture, it's not cheap, you have to pay interest. If you see equity share capital, you have to pay dividends. Preference shares are those shares for which dividends will be paid before equity shareholders. So such shares are called preference shares. They get a preference above equity shares. But retained earnings are those that earnings which is just our own money. If you're doing a small job and you're getting your salary, you keep a small amount in the bank. I call that as retained earnings. So any business which will just push on a small amount of their earnings is called retained earnings. In this, you neither have to pay interest nor do you have to pay dividend. So the cheapest source of finance is retained earnings. Let us go to the next question. Other things remaining the same, an increase in tax on corporate profits will, okay, if you're going to pay more tax, what happens, students? Debt will become cheaper. Why, students? Please understand that I'm coming to you for this topic. I'm coming to you to teach you trading on equity. While you're going to pay interest on debt, that interest is not taxable. So what happens, students? Because you don't have to pay interest on tax on interest, debt becomes cheaper. So increase in tax will make debt cheaper. This is the correct answer. Shall we go to the next question? A decision to acquire a new modern plant to upgrade an old one is. Now let us go to the 3 types of decisions. We have already seen this in cash flow statements. To understand about the decisions regarding the asset side of the balance sheet, it is called an investment decision. If we are going to look into the liability side of the balance sheet, we call it as a financing decision. If we are going to take a decision on the profit, I call it as a dividend decision. So here it is to acquire a new modern plant. It's a fixed asset, students. So what type of decision is this? This is called an investment decision. Let us go to the next question, students. Companies with a higher growth pattern, okay, what are those companies going to think of when they are going to think of growing higher? Naturally, the profit that they earn will be diverted to growth. So they will be able to pay lesser amount of dividends. So what is the answer, students? Pay lower dividends. Let us go to the next question. Higher debt equity ratio. What do you understand by debt equity ratio? It's just that debt upon equity. What is the meaning, students? As compared to the owner's capital, how much is the borrowed capital? So if your debt equity ratio is higher, the debt is higher, and what will happen, students? There will be a very high degree of financial risk. Why? Because, students, the company will always be in a danger of being liquidated, that is sold off and converted into cash. So this is the correct answer. Let's go to the next question. Financial leverage is called favorable. Okay, for this, I have to teach you what is financial leverage. I'm coming to that to that point when I'm teaching you trading on equity. Financial leverage, leverage is the gap, students. The gap between debt and equity is called financial leverage. So when will that be very favorable, students? When the cost of debt, okay students, the cost of debt is low, whereas the returns on equity is high. So you are having a very good earning per share and the cost of debt is low. At that time, it turns out to be a favorable financial leverage. So what is the correct answer, students? B is the correct answer. ROI, which is returns on investment, is higher than the cost of debt. Let's go to the next question. Current assets are those assets which can get converted into cash. Just now I taught you within a period of 1 year. So within a period of 1 year, it will be converted into cash. It will not remain as an asset. What is the example, students? For example, if you have a debtor who has to give you cash, he remains your asset till the time he returns the cash. And the maximum time he can take is maybe 6 months to 1 year. So this is what is called a current asset. So the answer is B, within 1 year. Let's go to the next question. Higher working capital usually results in, okay students, when you're having lot of cash in your hand, what will it result in, students? It will give you high risk. Why? Because your cash will be getting spent very easily. But it will also help you maybe to earn higher profits. So the correct answer over here is a higher current ratio, which is called the working capital ratio. The higher current ratio will give you higher risk, but also higher profits. Let's go to the next question. A fixed asset should be financed through, that is, how can you purchase a fixed asset? A fixed asset can be a land, a piece of land, it can be plant or machine, it can be furnitures or fixtures, it can be livestock also, students. So these are all called fixed assets. It can be investments which are more than a period of 1 year, like you are buying shares of another company. So these are all fixed assets. How will you buy fixed assets? Only through long-term funds, students. You can only buy it if you are having long-term funds, not funds which will be only for a period of 12 months. Let's go to the next question. Current assets of a business firm should be financed. Okay, after having studied fixed assets, how can you have current assets, students? You can only have current assets. You can finance them. You can pay them back only with okay, over here, not just with current liability, you can use your long-term liability also. So current assets will be financed through both current liability and long-term liability. What's the meaning, students? If you have to pay back your creditors, if you're not having enough cash in your hand, use some other fund, maybe, students, a bank loan or something, and pay him back. This is what is called financing of current assets. Let us go to the next question. Okay, the short answer, students. Let's go to the first question. What is meant by capital structure? So I have again just now taught you, it's a composition of debt and equity. And both debt and equity are long-term funds, students. So what will the effect of a capital structure be? It will affect the profitability and also the financial risk of a business. Which is the best one, students? It is optimum when the proportion of debt and equity is such that it increases the value of equity shares. To pay the debt, back debt will be an obligation, but when you increase the value of equity shares, that is the best capital structure. Let us go to the next short answer. What is financial risk? Why does it arise? So students, a financial risk is when we are not able to meet the financial obligations. What are financial obligations, students? If you have issued debentures, or if you have taken any big loan, you have to pay the interest. If you have issued preference shares, you have to pay them preference dividends. If you have taken any other borrowed funds, then you have to repay them. So this repayment of loans or to pay interest or to pay preference dividends, all this contribute to financial risk. When will it arise, students? The risk will come when the company doesn't have enough money. The risk will come when they don't have money to pay, and so the risk will be liquidation of the company. So this is called financial risk, and this is how it will arise. Let's go to the next question. Define current assets. Give 4 examples of current assets. So I've already taught you, students, operating or the operating cycle. It can be even an operating cycle. An operating cycle can be as much as 6 months or 1 year too. So an asset which will be an asset for a period of a year or up to the operating cycle, these are called current assets. And the examples are there: short-term investments as government bonds, inventories, that is stock, trade receivables, that is bills receivables, any short-term loans, loans which you have lent to others for a period of just 12 months. These are all the examples of current assets. That's the 4th question before you, students. What are the 3 important financial decisions to be taken? We have already seen investment decision. For this, you have to see the asset side of the balance sheet. Financing decision. I'm sorry, it is financial. It's written financial. It's financing decision. Financial decision is to look into the liability side of the balance sheet. And the 3rd decision is a dividend decision, in which we will look into the profit or loss statement of the business. After this, we will be going for a break. So let us see the 5th question, students. What are the main objectives of financial management? To estimate the amount of funds that are required to run the business, to ensure that the funds are available at a minimum cost, to maintain that liquidity position, that is cash should always be available. It can be converted to this and that, that's called flexibility. Ensuring efficient use of funds. These are the main objectives of financial management. So having studied this much, students, I hope you have understood. I want you to ponder in these points that we have studied. We'll come back after a very short break. Till then, keep tuned. Thank you.
जीवन ये प्रकाशित करने राहों को आलोकित करने हम अपना दीपक स्वयं बने हम अपना रास्ता स्वयं चुने हम अपना दीपक स्वयं बने हम अपना रास्ता स्वयं चुने जीवन ये प्रकाशित करने राहों को आलोकित करने
धन साधन समय की सीमा से विद्यालय जो मुक्त हो धन साधन समय की सीमा से
पढ़े हम कहीं पढ़े वे विषय की लोच से युक्त हो।
कभी पढ़े हम कहीं पढ़े वे विषय की लोच से युक्त हो।
मित्रों हम उठे और जागे,
मंजिल आने की ध्वनि सुने हम, अपना जीवन स्वयं बने हम, अपना रास्ता स्वयं चुने।
जीवन ये प्रकाशित करने, राहों को आलोकित करने।
राष्ट्रीय मुक्त विद्यालय का है द्वार खुला सबकी खातिर।
शिक्षा परीक्षा का अवसर एक बार ही क्यों मिलता फिर।
शिक्षा और परीक्षा का अवसर एक बार ही क्यों मिलता फिर। दुनिया में इसके केंद्र बहुत,
कोई मन चाहा केंद्र चुने हम, अपना जीवन स्वयं बने हम, अपना रास्ता स्वयं चुने। कोई मन चाहा केंद्र चुने हम, अपना जीवन स्वयं बने हम, अपना
So students, back to our topic, and after a short break. So shall we continue with the questions? The sixth short question will be, how does working capital affect both liquidity as well as profitability of a business? What is the meaning of liquidity, students? Liquidity is cash. Converting it into cash is called liquidity. You know, for a science student, water is liquid. For a commerce student, money is liquid. For a science student, because water flows, he says that water is liquid. And for a commerce student, money just flows off. If you have a certain amount of money in your pocket, it will flow off as in when you keep buying things. So money is the most liquid asset. Cash is the most liquid asset. So working capital affects the liquidity as well as the profitability of the business, because working capital will not give you much profit. There's very low returns. You cannot make it into a big profit. So it can only be gainfully developed. And for this, you will be able to pay off current liabilities with current assets. This is the effect of working capital. Let's go to the next question, students. Define financial management. You already studied what's management. Management is planning, organizing, staffing, directing, controlling. This is called management. When you do that for finance, you call it as financial management. Let's go to the next question. State the objectives of financial management. The primary objective, you know, students, here it's just written objective. So it's just a primary objective, and the primary objective is to maximize the shareholders' wealth. I also call it as the wealth maximization concept. The next question is, what does financial management aim at? Okay, the main aim is to reduce the cost of funds. You know, when you are trying to get funds through debt or through equity, you should not go in for very high expenses like advertising or promotion. You should try to reduce the cost. This is called reducing the cost of funds procured. Also, you should keep under control and achieve effective deployment of the funds. You should use the funds effectively. This is another aim of financial management. How do rising prices affect the requirement of working capital of an organization. You know, students, when the raw material prices increases, you need more working capital. So the working capital requirement will be high when the prices will rise. This is the effect, students. Name the financial decision which will help a businessman in opening a new branch. Just now we discussed that opening a new branch is an asset, and you have what decision is taken by seeing the asset side of the balance sheet? We call it as an investment decision, also called the capital budgeting decision. How should fixed assets be financed? How are you going to buy fixed assets like land, building, big machineries, plants? You can buy them by issuing capital. You know, it can be equity or preference shares. You can issue debentures. You can go in for long-term loans, or even if you are having enough of retained earnings, all this money will be utilized to buy big assets, that is called fixed assets. Investment criteria is one of the factors which affects capital budgeting. So I've already told you what are the factors which affects capital budgeting decision. What are the other factors, students? The amount of investment, investment rates, cash flow, and the rate of returns. Define dividends. So students, what is the meaning of dividends? If a person who gives you money in the form of share capital, what is the interest, students? He has also contributed capital. That means he's a part of the business. So the profit of the business becomes his also. So he will have a small share to the extent of capital that he has contributed. A small share in the profits of the business to the extent that he has contributed capital. So profits divided in portions is called dividends. How can taxation policy be a factor which affects dividend decisions? You know, students, when you are going to pay high dividends, okay, then tax rates, you can pay high dividends only when tax rates are very low. And it is just the opposite also. You can pay low dividends when the tax rates are high. So what are the objectives of financial planning? There are two main objectives: to ensure that funds are there with the business whenever required, and also to see that the firms, that is the business, does not raise unnecessary capital. The 18th question is, students, define capital structure. We just now saw capital structure can be a combination of debt, equity, and even other sources pushed in. It can be a triangle. A capital structure means the proportion of debt and equity funds. What does trading on equity refer to? This is a very beautiful topic, and I would like to explain to you what is trading on equity. To understand trading on equity, here is flashed on the screen an example, students. What's the example? This company is ABC Limited. The total funds needed for this company to operate its business is 30 lakhs. Let us see if three given situations are there. Case 1 can be where there are no debts issued. The meaning is, students, the entire capital is in the form of equity. The second case can be where 10% debentures. The 10% indicates the rate of interest. The 10% is also called the coupon rate. So what type of debentures have they issued? 10% debentures to the extent of rupees 10 lakh has been issued. This company, which requires 30 lakhs, if they have debentures in the form of 10 lakhs, which is called debt, the remaining 20 lakhs is in the form of equity. The third case can be where this company has issued 10% debentures of rupees 15 lakhs. So what's the meaning, students? This company, which requires 30 lakhs, it is having debt capital as 15 lakhs, and the remaining 15 lakhs will be in the form of equity. Now, given that the earning before interest and tax is 4 lakhs, suppose, and the tax rate is 50%, let us understand how these three cases would give us the necessary results. Case 1, case 2, and case 3. Now, the earning before interest and tax is the profit. The profit for all the three cases is 4 lakhs. That is what we have already given to you. That is, earning before interest and tax is 4 lakhs. Now, interest is the first obligation to be made out of profit. Please understand, students, even if the company does not profit, interest has to be paid, and that is risk. They may have to sell off the assets of the company to pay interest. Sometimes it may lead in liquidation of the entire company. So interest has to be paid. So let us see the first case. In the first case, I have said no debt is issued. So no interest has to be paid, students. In the second case, the debentures are up to rupees 10 lakh. If you have to pay interest at the rate of 10% on 10 lakh, the interest will be 1 lakh. In the third case, the debentures that are issued are 10% debentures for rupees 15 lakhs. So 10% on 15 lakhs works out to be 1,50,000. So this company, which is having profit of 4 lakh each, will pay interest. In the first case, no interest. In the second case, 1 lakh. And in the third case, 1,50,000. Now, after having paid interest, what is the earnings before tax, EBT? The earnings before tax will be 4 lakh minus 0. So that is 4 lakhs. In the second case, 4 lakhs minus 1 lakh, that is 3 lakhs. In the third case, 4 lakhs minus 1,50,000, that is 2,50,000. So the earning before tax is 4 lakh in case 1, 3 lakh in case 2, and 2,50,000 in case 3. After having paid interest, now let us pay tax. The tax rate given above is 50%, students. So on 4 lakhs, 50% will be 2 lakhs. On 3 lakhs, 50% will be 1,50,000. On 2,50,000, 50% will be 1,25,000. This is the tax to be paid in each case. Having paid tax, what is the profit left out with these in these three cases? In the first case, 4 lakh minus 2 lakh, the profit after tax is 2 lakhs. In the second case, 3 lakh minus 1,50,000. So 1,50,000 is the profit after tax. In the third case, 2,50,000 minus 1,25,000. So the profit after tax is 1,25,000. Now, what is this profit after tax? This profit after tax is the profit that is there with the business to be divided among the shareholders as dividends. So in the first case, what is the share capital of this business, students? Since they have not issued any debt, 30 lakhs is the share capital. In the second case, 10 lakhs has been issued as debentures. So the share capital will be, out of the 30 lakhs, if 10 lakhs are debentures, 20 lakhs will be the share capital. In the third case, the debentures issued are to an extent of 15 lakhs. So if 30 lakhs is the requirement, share capital will be 15 lakhs. Now with this profit after tax, how will you cover the shareholders? So what is the earning per share? So how will you calculate that, students? Profit after tax divided by 30 lakhs into 100. And how much that works out to be, students? In the first case, it works out to be 6.67 rupees. In the second case, they are having a profit of 1,50,000 to be divided. And the share capital is 20 lakhs. So how much is the earnings per share? 1,50,000 divided by 20 lakhs into 100. That works out to be rupees 7.5. It's better than the case 1, you know. The earning per share is better than case 1. Let us see the third case. In the third case, the profit after tax is 1,25,000. The share capital is 15 lakhs. So 1,25,000 divided by 15 lakhs into 100 is equal to rupees 8.33. What do you understand, students? When no debt is required, the earning per share is low. When little debt is required, it's better, but it's not as high as the third case, which is 7.5. In the third case, we see that the earning per share is much better when there's a very good balance of debt and equity. So the gap between debt and equity, which is called financial leverage, is called trading on equity. So this is the concept of trading on equity. It's a very important concept, and the financial managers have to decide how much are they going to trade in equity by first fulfilling the obligations of debt and then seeing to it their earning per share is the best as compared to many. So this is what is called trading on equity. This also explains to us about the characteristics of debt and equity. It also explains to us financial leverage. So this is what I wanted to teach you about trading on equity. Let's go to the next question, students. What is, yes, that's what we saw. The next question, what is meant by long-term investment decision? The answer is capital budgeting decision. What are the factors, students? The cash flow of the project, the rate of return, the investment criteria, anything that is involved. State any 3 advantages of debentures. Okay, students, debentures is debt. That's all plain. Debentures is debt. Why do you issue debt? What are the advantages? Because interest paid is always lower than the dividends that you pay on shares. Secondly, the interest on debentures is tax deductible expense. That is, after paying interest, the remaining amount only is taxed, students. So there's not so you pay tax not upon the interest. This is the advantage. The third one is, students, debenture holders are not entitled to vote. So there is no loss of control. So who will have the control, students? The manager who has issued debentures. He will have full control. He does not need to give his control to the debenture holders. These are the 3 advantages of debentures. This is a small case problem. The directors of Lavanya Limited have decided to expand the business activities by increasing the stock of raw materials and finished goods at an estimated cost of 5 lakhs. As a finance manager, advise the directors about the methods open to the company to raise the necessary finance for this purpose. So if you want to raise students' finance, you can issue shares, you can issue debentures, you can go for loans from banks, retain earnings. These are some of the important ways to raise finance. What is meant by financing decision? I've already told you, students, the capital structure is called the financing decision. So the quantum of long-term funds, whether it's debt or equity, is called the financing decision. What are the factors to be kept in mind, students? The cost, cash flow position, level of fixed operating cost, cost consideration, and very important is the state of the market capital. Okay, students, what is working capital? I've given you the formula over here. Working capital is equal to current, that's net working capital. Net working capital is equal to current assets minus current liabilities, where if you are having current assets more left after fulfilling your current liabilities, it is called working capital. How will you determine, students? Depending upon the nature of business, the scale of operation, the scale, business cycle, the production cycle, credit allowed and credit await. These are some of the factors to be kept in mind. Explain the factors affecting dividend decision. Okay, dividend decision, you know, students, if you want to grow more, you cannot pay as much dividends. So, for growth, less dividends has to be paid. Stability of dividends is a very important factor. Access to the market, capital market consideration, that is, are you able to easily raise capital in the market? That is called, that also will affect your dividend decision. Shareholders' preference will also have to be kept in mind. Any legal restrictions, rules or regulations, the amount of earnings will always be a factor upon which your dividend decisions will be kept in mind. The stability of earning, the cash flow position, the taxation policy, the stock market reaction, contractual constraints, as I said. What are bonus shares, students? You know, shares which you can issue out of the uncalled capital is called bonus shares. When you decide what is the amount of capital to be required for your business, I call it as the authorized capital. Authorized capital is the capital which the board of directors will authorize for a particular business. Out of this, you can call up some capital and some capital will remain uncalled. This uncalled capital can be given as bonus shares. This is another factor to be kept in mind as to how much bonus shares you can issue. Inflation will also be an important factor to be kept in mind while taking a capital budgeting decision. Capital structure decision is essentially optimization of risk-return relationship. Isn't that so, students? A capital structure decision depends upon the risk and the returns. Okay, there's a relationship to it. Okay. Next question. What are the factors which will affect the capital structure of the company? The capital structure, it's a proportion of the capital structure. So, you know, students, it will be, it will mainly depend upon equity and debt. There are other long answers, students. We have seen them again. Dividend decisions. What are the factors? Financial planning. I've already taught you. And what is the importance of financial planning? So these are some of the, okay, explain the meaning of fixed capital. Okay, student, this are also, yeah, one question. And then what are the factors which affect the working capital requirements? Hot students, name the concept. Name the concept which increases the return on equity share with a change in the capital structure of the company. So just now I taught you that concept, and that is trading on equity or financial leverage. I just now taught you that it increases the return on equity when you are going to go in for more debt. So this is called trading on equity or financial leverage. In what kind of situation does favorable financial leverage occurs? I taught you case 1, case 2, case 3, students. When did you see that a favorable financial leverage has occurred? When the earning per share is more. That is called a favorable financial leverage. What should a company issue? Share or debenture? If it does not want to lose control. So when it does not want to lose control, no, students, debenture is the way. When you're issuing share capital, you will lose the control. As many shareholders, all will have equal control all will have control to the extent of the capital contributed by them. Identify why the requirements of fixed capital for a trading concerns are different from that of a manufacturing concern. What's a trading concern? What's trading activity, students? Buying and selling is called trading activity. Okay, so you're already buying finished goods and then selling it at a profit. In this, the requirement of working capital will be less, whereas the requirements for a manufacturing concern in which you have to buy, you have one plant, machine, you need the raw materials and everything. In that, the requirement of fixed capital will be more, and in a trading concern, the requirement will be less. It refers to investment in long-term assets. What is that type of capital, students? Investment in long-term assets is called fixed capital or capital budgeting decision. How does production cycle affect the requirement of working capital? If your production cycle is a long cycle, then more will be the requirement of working capital. Identify the decisions taken in financial management which affects the liquidity as well as the profitability of the business. Which is the decision, students, which affects the liquidity and the profitability? Working capital decision, also called the short-term investment decision. If companies have easy access to the capital market, what decisions regarding paying dividends should be taken? If they have easy access to the market, students, you will pay higher amount of dividends. It's easy to raise funds through the capital market because you're having access to the capital market. Typically, financial planning is done for 3 or 5 years. Why not for long periods? You cannot make a plan successful for planning beyond 3 years, students. So you have to go again beyond it. That is why the last step in planning is follow up. Students, we have to follow up. So we shouldn't go in for a long period. So it should be typically 3 years. Is trading on equity advisable when the debt reduces? I just now taught you 3 cases, students. When debt is more only, trading on equity is advisable. So the answer is no. If stock market are bullish, then what would be more easy for the company to issue? Students, bullish and bearish are the 2 conditions that operate in stock market. Now, bullish is when the bulls, those agents who try to push up the value of the stock, they are called bulls. So they're always trying to increase the value of the stock. Now, those who wait for times where the market will when the stock can be brought down to a lesser price, we say that the market is bearish. So for bullish, students, the equity shares can be issued more easily at a higher price. How can a liberal credit policy affect working capital requirements? In a liberal credit policy, you can have large amount of working capital. That brings us to the end of this chapter. But before I wind up, students, I would like to go in for the questions that has been passed on to me through WhatsApp, and let us see some of the questions. Okay, on financial management, what are the questions that has been asked? Okay, the first question, students. Name the financial decision which will help a businessman in opening a new branch of business. So, new branch is an asset. So, the financial decision will be investment decision. The second question is, what kind of decision involves distribution of profit to the shareholders? We have already seen, students, in the 3 cases that the profit after payment of tax is a profit that is used to divide among the shareholders. And so this is called the dividend decision. The third question, which type of dividend policy should be followed by a company having growth opportunities? So if you want to expand your business, if you want to make your business big enough, you cannot keep distributing your profits easily as dividends. So a lower rate of dividend policy will be followed when you are having plans of going for growth opportunities. The fourth question, how is cost of debt affected by increase in tax rate? Just now I taught you students in case 1, 2 and 3 that the cost of debt will be cheaper. Yes, that is how the cost of debt will be cheaper when we have an increase in the tax rate. Okay, students. So naturally, students, you don't have to pay interest tax on the interest that you pay to the debtors, to the debenture holders. You don't have to pay tax. So when you're having a high rate, debentures is the best type of funds that you can issue. Next one. Name the type of investment decision which relates to short-term and affects day-to-day operation of a company. This is the working capital decision. How do growing opportunities as a factor affect dividend decision? If you want to grow, it's again a repetition. If you want to grow your business, you cannot go in for higher rate of dividends. State the objectives of financial management. We have already seen that through the flow chart. How does cost of equity affect the choice of capital structure of a company? The cost of equity is very, very important, students, which will include the flotation cost, it will include the promotion cost, it will include the payment of dividend. All this will be the cost that which will affect, students, the cost of equity. So keeping in mind how much cost you can bear, you will have to take a particular capital structure decision. So cost of equity is one factor to be kept in mind while deciding the capital structure of your business. Ninth question, what is meant by trading on equity? Shall we quickly go to understand that, students, to understand what is meant by trading on equity? I'd like to explain to you all what is trading on equity. Again, we have already seen. Let me go quickly, students. Once again, we have that little important time with us. Look at the example of a business which is called ABC Limited. Now, suppose the total funds needed for this business is 30 lakhs. Let us take three situations. This is the capital structure as a case, students. The three situations are the situations of the capital structure. Case 1, no debt is issued, students. So there's no debentures or something like that, bonds or something like that. So no debt is issued, students. So what happens, students? Only the entire fund will be in the form of equity, which is rupees 30 lakhs. In the second case, we have issued debt to the extent of 10 lakhs. When the requirement is 30 lakhs, beyond 10 lakhs of debt, 20 lakhs will be equity. In the third case, students, if suppose we have issued 10% debentures to the extent of 15 lakhs, now for a requirement of funds of 30 lakhs, what will be equity, students? The equity will be up to 15 lakhs. So what do you understand, students? Case 1, the entire fund is in the form of equity. Case 2, 20 lakhs is in the form of equity and 10 lakhs in the form of debt. In case 3, 15 lakhs is in the form of equity and 15 lakhs in the form of debt. Now suppose the earning before interest and tax is 4 lakhs and the tax rate is 50%. What happens, students? Let us say take case 1, case 2 and case 3. So the earning before interest and tax is 4 lakhs, 4 lakhs, 4 lakhs as given above. Now let us pay interest, which is obligatory and which has to be done. Whether they have profit or not, they sometimes have to pay by selling off the assets of the company. Sometimes it may lead into liquidation also. So interest in the first case is nil because there is no debt issue. In the second case, the debt is up to 10 lakh students. Now 10% is the rate of interest. So on 10 lakhs, 10% interest will be 1 lakh. In the third case, the debt is up to 15 lakhs. 10% on 15 lakhs is 1,50,000. Now having paid interest, what is the earning before tax? Let us minus it, students. 4 lakhs over here, minus nil. Okay, you're having 4 lakhs as earning before tax. Over here 4 lakh minus 1 lakh, 3 lakhs. Over here 4 lakhs minus 1,50,000, that is 2,50,000. Now let us pay the tax, students. It's 50%. So 4 lakh, 50% is 2 lakhs tax. Over here 1,50,000, that's 50%. Over here 1,25,000, that's 50%. That is the amount of tax. Now after having paid tax, what is the profit after tax? Here 4 lakh minus 2 lakh, it's 2 lakhs. 3 lakh minus 1,50,000, it's 1,50,000. 2,50,000 minus 1,25,000, it's 1,25,000. This is the profit after tax. This is the tax, this is the profit that is there to be divided among the shareholders. Now this is what we understand about, okay students, when we convert it into earning per share. For that, what is the share capital in the first case? Since no debt is issued, the entire 30 lakhs is the share capital. Here debt is up to 10 lakhs, so remaining 20 lakhs is the share capital. Over here debt is 15 lakhs, so remaining 15 lakhs is share capital. So earning per share is profit divided by 30 lakhs into 100, which turns out to be 6.67 rupees in the first case. In the second case, 1,50,000 is available among shareholders of rupees 20 lakhs. So 1,50,000 divided by 20 lakhs into 100 is rupees 7.5. In the third case, 1,25,000 is there to divide among a total of share capital of 15 lakhs. So 1,25,000 divided by 15 lakhs into 100 is equal to rupees 8.33. So this is called, okay students, trading on equity. We have traded on equity to understand this. So that is what is the ninth question. Let us go to the last question, students. Name the aspect of financial management that provides a link between investment and financing decisions. It's if I'm right, it's financial planning. I'm not very sure. It's financial planning. Okay, students, that's financial planning. Thank you for being with me. Please work hard on this subject, and I'll continue to be with you all again in the remaining sessions. Bye, students.